Okay, let's start. Good evening, everybody, and it's a pleasure to welcome you here at this webinar of M&M, Idee per un Paese Migliore. This webinar is devoted to a report of the Group of 30. The Group of 30, as you know, is a group of eminent bankers and economists from all over the world. And this report was devoted to reviving and restructuring the corporate sector post-COVID with some important policy indications. We have with us as our guest speaker, Douglas Elliott, who coordinated the group. As you know, the group had a steering committee who was composed by 4 eminent economists and bankers, among which a person who's very well known in our country was, and not only in our country, was Mario Draghi. The Douglas will be interviewed by Francine Lacroix. Thank you, Douglas. Thank you, Francine. Francine is one of the most influential journalists, business journalists in the world, one of the most recognizable face in business TV, and particularly Bloomberg. Thank you, Francine. We will have also 3 discussants, but Francine, we will introduce them later on. Just a couple of words on the event, and then on M&M. Well, the event has to be considered a public event, so there's nothing sensitive which should be said. It's and also it will include a presentation by Doug, the discussant, and then some Q&A. M&M is an association recently founded a year ago, more or less, which gathers people from different background, political background, and background, with managers, with academics, civil servants, diplomats, and so on. We try to combine a few different words, the words of Milan and the words in Rome, which usually don't speak to each other, but in that. It's not really a think tank because we don't have clients. We do not write on demand, but we write only when we think, on a voluntary basis, when we think that we do have something to say or a value add. We provide some notes to everybody open source, to the policy response to economic side. And one of those today got really the limelight, because it was mentioned by the former Prime Minister Renzi in a letter to the current Prime Minister. So our note got a bit of how can I say, of a spotlight today. Nothing else to add. Thank you, Francine.
Thank you so much. Thank you, Fabrizio, and thank you so much for everyone joining us. We have 1 hour. There is a chat function on Zoom. Please send me all the questions. And congratulations, Douglas, on a great report. I printed actually all 88 pages twice this week. That's how important it was for Bloomberg. And of course, it stresses the report, the time for policymakers to act to head off this looming corporate solvency crisis, and the time is now. So why don't you take the floor, and then I just wanted to introduce our participants afterwards, our panelists. I'm delighted to be joined by Diva Moriani, entrepreneur and private equity manager, member of the board of Generali and Moncler, in conversation also with Marcella Panucci, partner at Cleary Gottlieb and former director general of Confindustria, the banker and former director general of the Ministry of Economic Development. So we'll have a discussion afterwards for the 4 of us, but please send as much as you have and you want. And Douglas.
Thank you very much, Francine, and thank you, Fabrizio. Yes, so as was mentioned, this report is for the Group of 30. The 2 co-chairs of the project were Mario Draghi and Raghu Rajan, the former head of the Central Bank of India. And myself and Victoria Vashin of Harvard Business School were the project directors, so we're the ones who essentially co-authored the report with considerable input from the G30. 4 main parts of the report. First is we lay out why it is that we're collectively concerned about corporate solvency crisis across the globe. And whether that occurs and the degree to which it does will vary by country. I've not specifically looked at Italy, but I'd have to say from what I know of it, it's likely to be a bigger problem in Italy than in many of the countries we're looking at. The second part of the report lays out 10 principles that we think policymakers around the world ought to consider, ought to abide by as they build their policy responses. And I'll go into a few of those. Third part of the report lays out 4 buckets of policy tools that we think would be particularly helpful in dealing with corporate solvency issues. And then the final component is we put out a decision framework in some detail. We didn't want to give a one-size-fits-all answer because there are massive differences across the globe between countries and their situations. But what we did want to do was provide some serious advice about how to think through these policy tools and combine them with the circumstances of each of these countries to come up with the best answers. So in terms of why we think this is an issue to be concerned about, some people have pointed out that in many countries, there have been fewer insolvencies in the corporate sector this year than there were in 2019. We don't think that tells us very much because we've had massive amounts of aid put out into the corporate sector, as well as more broadly. Many companies have benefited from the fact that their clients actually have more household income in some cases than they had the previous year, such as the sheer volume of aid being provided. But this aid is going to stop at some point. And then we'll see how strong these companies are. And in the meantime, they've taken many temporary measures, cut corners here and there. They've hocked the jewelry. They've done whatever they could to get through this period. So when the aid does end, they'll be many of them in considerably weakened conditions. So I may have to come back in 9 months and apologize for being worried about something I shouldn't have been worried about. But at this point, we think there is a very high risk in many countries of a quite serious corporate solvency problem. And that would play through both to the larger economy and of course to employment very directly. So that's why we're concerned and we think something needs to be done. In terms of the principles, I won't walk through all 10 here, but a few I think of particular importance. First is we need to switch from a focus on liquidity, making sure that there's enough cash to pay the bills for these companies, to solvency. In the short run, the right approach has been to take a fire hose and spray liquidity over everything. Because at the beginning, there was a real concern we could go into a true depression. And that's much too serious not to take actions that were taken. But that's not sustainable for long periods. And for a company, you don't make it more robust in the long run by piling additional debt on top of the debt that already existed, in many cases at fairly high levels. So we need to focus instead on investments into these companies rather than adding debt. A second principle is that we need to target. We're not going to be able to just keep pouring out massive amounts of government support. So the companies that should be aided, and I'll come back to how best to do the aid. I'm not talking about just government money, but the companies that should be aided are those that will be viable in the long run, but have trouble getting the financing they need in the markets. So we shouldn't be devoting taxpayer resources to companies that are going to die regardless, or would become zombie companies that would barely be able to keep ticking over, barely be able to pay their debts, but wouldn't quite go bankrupt. Those aren't good for the economy. At the same time, there's no point in using scarce resources to help companies that will be fine without it, that either don't need the types of investment we're talking about or can obtain it readily in the markets. As we're seeing, to some surprise, many of the larger companies do have good access to the equity markets, for example. So we want to target it to that set where it'll make a difference and where it's needed. Third thing is, and this ties into the targeting, we need to use the private sector as much as possible in a given country. That is, private investors and lenders have the expertise to sort out viable companies from non-viable companies, and they have many fewer constraints than governments do on directing the funding towards the viable companies. It's also a good way to leverage taxpayer money. Instead of having everything coming from the state and ultimately taxpayers, it's great to have maybe use incentives of various kinds, but as much as possible to use private sector funds. And then a fourth principle I would highlight is that we need to focus on the economy of the future, not the economy of the past. It would be a colossal waste of money if the government tried to restore the economy to what it looked like prior to the pandemic. As we're all well aware, this period has accelerated many trends that were already happening, like digitization, but it's massively accelerated it. So we just have to accept that's the world going forward and target those companies that can survive in that world. So those are the broad principles. In terms of the buckets of policy tools, the first bucket, and the most effective in many ways, if you're in a position to do it, is to get equity and quasi-equity into the companies. Now, quasi-equity covers a very wide range of things. It could be preferred shares that they have profit participation. It could be like the Crédit Participatif in France that are loans but have profit participants and need to be repaid in shares. There's a wide variety of things you could do. You could even have taxpayer money go in and be paid back by higher taxes on profits of those specific companies, higher tax rates for them until it's been repaid. So there are a lot of ways to do this, but the key is to increase the financial capacity of companies without adding debt. So there's a whole set of things that can be done there. Second bucket is if you can't do it through the first bucket, you're going to have companies that are going to go bankrupt or be on the edge of bankruptcy. And there, the key is to convert some of the debt into equity. Now, bankruptcy processes already do that. That's a key component. But first of all, most bankruptcy regimes around the world assume that if you walk in the door of a bankruptcy court, you have a bad business. The spirit of Chapter 11 in the US Bankruptcy Code is much better suited to this current situation because it starts with the assumption that you're walking in with a sound business, but it has an unsound balance sheet. And that will be applicable to the great majority of companies that run into trouble in this particular very strange environment. So one thing to do is the problem with that, and I think it'll be especially true, is it takes a million years to make changes in bankruptcy. So we also suggest use contract law. They'd be voluntary, but have the government lay out a framework for speedy, efficient, cheap ways of getting balance sheet restructurings and probably will need to provide some level of tax or monetary incentives to persuade all of the debtors and creditors to come together voluntarily within that quick time frame that we're looking for. The third bucket is to say, if the first two buckets haven't worked, then they won't work for everything. You're going to have significantly higher non-performing loans on the balance sheets of the banks. So we're saying there will be a bad debt problem. And there are a series of things that can be done that will help society as a whole deal with that. Many of you are familiar with the ideas of asset management companies that are specifically designed to deal with bad debt, such as Spain or Ireland used in the last crisis, China's used, and these are being actively considered across Europe at this point. So we have quite a lot of explanations of those tools and how they might be used. And the fourth bucket is really probably, I would think of a way to use it now, but it's probably really more for the future. And that is the potential for government reinsurance of pandemic business interruption insurance. Now, that's a lot of words strung together. So let me explain by that. Right now, companies can buy business interruption insurance, something that means they can't operate or have to constrain their operations for a period of time. But sensibly enough, insurers have excluded pandemics because that's just too big a problem, as we're seeing with this crisis, for the insurance industry to handle with its financial resources. Only governments can really handle this volume. So the idea would be to provide for reinsurance that would mean that the government would take the great bulk of the losses beyond a certain level from this type of business interruption insurance. By taking on those losses, it would make it possible for private insurers to take away the exclusion of pandemic risk and treat this like any other business interruption. Now, this will clearly have costs for the government. I don't think you can realistically price this where the premiums for that reinsurance or the underlying insurance would be enough to cover these risks. But I would urge you to compare that to the current situation, where what happens is governments come in when the actual emergency occurs. They pour out very large sums of money on an ad hoc basis without much time to plan how to do it. Much better to simply accept that this is something that realistically governments will do and lay out a framework for it up front and incorporate it into these business interruption insurance contracts. So my final point I've pretty much made already up front, which is we don't have a one size fits all answer. Countries differ too much. So instead, to be useful as policymakers consider the rest of the tools we laid out, we have a decision framework, a series of questions and of issues to be considered, and guidance in that section to help policymakers reach the best solutions. And we remain available to talk with officials in various countries about how to apply the concepts in the report to their particular situation. So thank you for letting me give that long monologue.
Douglas, thank you so much. I have 3 questions for you, and then I want to go to the other panelists. But first of all,
yeah.
do you have any idea of how many zombie companies are being helped right now? Like, you know, or should we be really worried just about the viability right now before we get on to who needs aid and who doesn't?
Yes, look, I do think there are a number of zombie companies. Now, that does vary across countries. Oliver Wyman, the consulting firm I work for, has done a lot of analyses in different countries. The results are confidential, but just to give you a broad feeling of it, what we found is about 20% of companies, and that's number of companies, many of them are small. I should have said earlier, by the way, small and medium-sized enterprises have been particularly hard hit and have particular trouble getting the financing they need. So a lot of the report focuses more on them. So number of companies is not the same as the percentage of the total economy, but by number of companies, approximately 20% of companies we thought would either become zombies or would be so unviable they'd actually go bankrupt. And the breakdown between those two varies, but there's quite a lot that we think will be zombies.
May I interject? How do you define zombie? Perhaps that would be useful for everybody.
Sure. There's no one accepted definition. What we used was to say, these are companies that will either barely be able to pay their interest obligations or won't be able to pay the ongoing interest obligations, and certainly won't be able to pay down the principal of the debt. So they'll spend the rest of their lives, or at least our projection period, struggling just to keep from going bankrupt.
Douglas, who should decide what companies should get assistance? This is crucial, and who has the expertise actually to foresee what company will do well and which one will go bust without help?
Yeah, this obviously will vary to some extent by countries, but as a broad statement, we think in the ideal situation, governments will lay out the broad principles and then provide incentives for private sector investors, whether those are pension funds, insurers, asset managers, banks potentially, though banks tend to focus much more on loans than they do on equity and quasi-equity. But let them make the choices, because the private sector has, as I noted earlier, a lot more expertise in evaluating viability, and governments have huge political constraints on saying no to anybody.
Let me also bring in Diva, Marcella, and Stefano. Marcella, let me maybe start with you. What are you seeing in Italy? What do you worry most about in Italy? So is it the small and medium-sized enterprises that are most at risk of being propped up without much substance? And again, how do you make the difference between a healthy company that can focus on digitization and the green economy?
Okay, thank you, Francine. It's a very interesting question, and thanks to Douglas for a very interesting presentation. I read all the reports, and it's really amazing how useful proposals it contains for every single country. How I see the situation in Italy, I do agree with Douglas that we have around 20% of companies, mostly SMEs, that are so-called marginal, which means that they're about to exit the market because they are over-indebted or anyway not competitive any longer. There are 60% of companies that are transitioning, let's say, they are facing some difficulties, but they may resist and grow. And there are 20% of excellent companies, which means that they not only resisted through the crisis, the pandemic, but they also grew and reacted by investing, by transforming their production, by accessing international markets. This is a situation that has been photographed by Cerved, that is an inquiry company that makes surveys in the economy. What are the characteristics of these 20% of excellent companies? They are well capitalized, which means they have a good balance between debt and equity in their balance sheets. They are very innovative, which means they have kept on spending and investing on innovation, both in products, processes, in material goods, which means marketing, communication, trademarks, and so on. And they are internationalized. And the difference is not really depending on the dimension of the company, which means they may be SMEs or bigger companies. And SMEs are solid, especially when they belong to international global supply chains. In this case, they are quite solid because they have invested in the relationship with their both clients and suppliers. The situation, and these companies have kept on investing during the crisis, and they have kept on making acquisitions also in other countries, so I'm not worried about them. I'm worried about those companies that are highly indebted. You know that during the crisis, the Italian economic system has absorbed 130 billions of incremental debt, which was backed by state guarantees. And most of these companies are SMEs. Around 120 billion of additional debt was asked by small and medium-sized companies. This means that these companies will have a problem with the new year when the economy will be defrosted, because you know that now all the rules that impose recapitalization for losses are suspended until the end of the year. But with the new year, I'm wondering what's going to happen. So I think that an intervention is absolutely necessary. I do agree with Douglas and with what's written in the report. We don't have to choose sectors. We don't have to choose which industry to save or not. We don't have to choose whether to save SMEs or bigger companies. We should leave it to professional investors who have the ability to target those companies that have to be saved or that have to be invested in. I think that this is the moment to allow for a strategic transformation of the Italian economic system, because we do need stronger companies. We do need to increase the dimension of Italian companies from smaller to medium-sized companies, not only to save them, but to allow them to invest on the future challenges that the industrial system has to face, which means digitalization, which means green transition, which means accessing international markets. So this is the time really to act. And I think that the government intervention should be focused on supporting, from a fiscal point of view, all the investments in equity and quasi-equity. We have a very good tradition in Italy, because in the last 10 years, thanks to some previous governments, and Fabrizio and Stefano were part of these governments, and they really well acted in the field of finance for growth, because the situation of the Italian economy is much better now than 10 years ago. There's much more equity in the balance sheets of companies, also SMEs, now than 10 years ago. And this situation has radically improved thanks to the measures that the governments, of which Fabrizio and Stefano were part, adopted. This very good and virtuous process has stopped during the pandemic, so we have to reactivate it. And now it is time to do that. And I hope that the government will adopt fiscal measures and will help to cover those gaps in the market when we need professional investors in order to support companies. Unfortunately, I haven't seen in the documents that have been circulated to the press regarding the Next Generation EU initiative and the reform plan of the Italian government anything about that. I mean, there are no measures which are aimed at supporting equity and quasi-equity investments into companies. I hope that this is just a question and a problem of a bad summary, and that the measures may be contained into more detailed projects, because I really think that it is important to support the Italian economic system during this particular transition. Just a very last remark. What I'm really think it is important to emphasize is that the Italian industry is really strong. We are the second manufacturing country in Europe, and we are the 5th in the world. So we are not a weak economic system. We are a competitive economic system that needs to be upgraded. So thanks a lot.
Thank you much. And Stefano, why don't I ask you a similar question, which is basically what kind of criteria should the government be looking at in small and medium-sized firms before allocating resources? If we have Stefano.
Yeah, I'm here.
We hear you. Great.
Sorry. Well, let me put, I would like to, rather than comment on what Douglas said, which I tend to agree in for the vast majority of the arguments, I would like to put some questions to Douglas. And I have 4 questions, basically. One, it concerned exactly what he was mentioning about how the liquidity went to small, medium-sized firms in distress, and how liquidity went equally through this indiscriminate approach also to firms, small, medium-sized, and large firms, who actually didn't need that much support. And this has created, for example, in Italy, a huge amount of liquidity in the current account of many, many corporates. And my question is, how can we make this liquidity working for the investments purposes? In other words, if Douglas sees some possible problems of a liquidity trap in the economy, because we have huge stock of liquidity, we have a huge uncertainty, very low interest rates, and some sort of Keynesian liquidity trap may occur. One thing. The second question is to involve the private sector, and this is one of the key message that our association at the MM has put forward towards the government. If we want to involve the capabilities and the resources of the private sector, we should lower barriers and bottlenecks and regulatory constraints which are sometimes impeding such involvement. So reforms should go hand in hand with investments. And this is key. Do you think that there is enough political commitment in achieving reforms in order to push investments? The second question, if I can, very briefly, is you mentioned the need for creative distraction, no? The fact that you have to be selective somehow, and I agree. But to achieve creative distraction, you need to think that the factors of production, labor and capital, are very mobile. But we know, and in Italy in particular, such factors of production are very sticky. And so how can we allow the mobility of capital and the mobility of labor in order to achieve a creative distraction which does not create huge social cost, at least in the short run? And my last question is about NPL. We know, I agree, that governments may need to intervene to protect or bolster the ability of the financial sector, in particular the banking sector, to support economic recovery. But this responsibility is also in the hands of independent regulatory and supervisory authorities. Do you think that governments and supervisory authorities are going hand in hand, are heading in the same direction in this area of helping a financial, a banking industry and a financial system to be helpful for the recovery of the economy?
Douglas, let me just jump in here very quickly before you answer those,
Sure.
because I wanted to make sure that everybody knew you can also ask questions. There's a group chat, there's a Zoom group chat. It's very 2020, it's the in thing, and you can just ask questions, either say, I want to ask a question, give me your name, or just ask them directly. Douglas.
Okay, well, Stefano, of course, has set me up with extremely difficult questions, which spread into broader macroeconomic issues. I will do my humble best to provide some answers, but I don't think I'm going to do very well, truthfully. So first of all, on the liquidity trap, I don't know enough about the Italian situation to answer specifically there, but certainly as a general matter, what you described would be troubling if you have that kind of liquidity trap. Classically, the way you get out of liquidity traps is to, on the one hand, reduce the level of uncertainty so that companies don't feel like they have to keep all that liquidity. And there are various things you can do with that, including providing backup programs to provide liquidity if needed, so companies don't feel like they have to hold their own liquidity directly. And the other side of it is to find ways to make investing more attractive, which to some extent goes into your second question. That is, as you're sitting at a company and you have a bunch of extra cash, you're weighing the risk reduction benefits of holding the cash. We'd like to make that less important so they don't feel they need to hold as much. And on the other hand, what the rewards are from deploying the cash. So we want to find ways to make productive employment of that more attractive. And I'm sorry that's a very general answer, but the devil's in the details. In terms of lowering barriers to investments, I think, if I understood it right, I think you kind of had a mix of two related questions in terms of barriers to investment, but also reforms in the larger economy that would make, basically that would make businesses more attractive and therefore would encourage investment. And there, all I can do is say, yeah, it's good to get rid of barriers to investment that aren't truly necessary. And I am a believer in economic reforms and of the difficulty that many countries have in doing them politically. So speaking at a very general level, I would encourage doing the necessary but often politically hard things. But that's at a really high level. In terms of creative destruction, well, you do raise a point. If there are too many constraints on the factors of production, so you can't redeploy the capital or you can't redeploy the labor, then destruction can just be destruction rather than freeing up the factors of production to be employed in a more productive manner. I think it's probably possible to exaggerate those barriers. I think at the end of the day, economies are pretty good at redeploying resources. It may take longer than we'd like, and it won't all happen, but doing what we can to make that work better would be good. I also, as you know, it's an 88-page report and a lot of implications of it, so there's a lot I left out, but I probably should just emphasize, we are a strong believer that while you let the creative destruction happen, you do provide appropriate protections for the workers who are being thrown out of work. You know, talking about training, we're talking about welfare for the period that they're going to need to make transition, and longer term assistance for those who won't be able to find other work. I didn't mean to focus just on the corporations themselves. In terms of the non-performing loans and the potential for creating new non-performing loans, Stefano, obviously you're absolutely right to point out there is an inherent tension, you know, and there always is, between, do you want a system which is as safe as possible but doesn't do very much, or do you want a system which can allow the economy to really roar ahead, but where you're going to fall off the cliff periodically? That's a broader issue in general. And of course, the global financial crisis pushed us towards making things substantially safer, even knowing that would create some breaking of some slowing down of what the economy might do in non-crisis years. You have a version of the same issue as you're pointing out in the current circumstance. Do we push banks to just keep making loans almost regardless because we need the money in the economy, and banks are particularly good at directing it to the individual companies? Or are we so worried about non-performing loans that we really want to focus on maintaining capital, minimizing the losses from new loans, et cetera? You know, and there again, the devil is in the details. I follow what the SSM does, for example, but in terms of more localized Italian choices, and I will say, more broadly speaking, I'm comfortable with what the SSM is doing. In terms of Italy itself, I don't know enough to be able to usefully comment.
Douglas, thank you. Let me ask a question to Diva, and then we'll go to a couple of questions from the people in the audience. Diva, how difficult actually is it to implement what Douglas was talking about for Italian companies? Diva, I don't know if you're there. Diva Moriani.
Oh, sorry.
I cannot hear you. So there you are. Perfect.
Sorry.
We can hear you.
So let me play a little bit of the role of contrarian here. The issue is actually the business, the corporation are currently paying most of the bill of this pandemic crisis. And why this? Because basically they have been obliged to stop their activities, or they, of course, they faced a different market, of course, but mainly the main part is being stopped and have been forced to stop their activity for, let's say, public safety reason. Okay, so basically there is one part of the population, one player in the system that has paid the whole bill. On the other side, there is, I don't know, the public employment or other kind of classes that basically didn't pay the same. Okay, this is, I think, a tremendous unbalancement in the system. Now, there is some let's say, intervention that is put in place from the government here in Italy that unfortunately going through the, let's say, the banks didn't work so well, given the fact that the most, let's say, the guarantees of the government was not always 100%, but was a partial guarantees. And of course, this started to clash with banks' requirement to fulfill certain rules for their own balance sheet. So this is a little bit created such a distortion that also Stefano was pointing out. And here is a matter of governance, because if the government decides to put in place intervention in order to save the economy, the real economy, there has to be somebody in the middle deciding that maybe this money cannot be given to somebody that doesn't need it, okay, and put this in its own bank account. So more than focusing on non-viable or zombie companies, because if we continue like this, the most part of the companies will become zombie companies, and also the shared statistic maybe will not be the same in a while. I think that maybe first the governance has to focus itself not to allow banks to release such kind of financing, granted financing, partially granted financing to companies that doesn't need it. Okay, so first part, don't help who don't need help, and focus on who need helps, and then the possibility to judge who will be viable in the future or will become zombie companies in the future. It's very hard to say, because nobody can plan, can understand, can forecast when the market will be back and normality will be back. So it's clearly, this is a kind of protection, public protection that has to be given to the corporate system, not because of entrepreneurs or shareholders, but because of the employment that is connected to this. Because once we stop giving money to companies, this come back immediately with a tremendous social problem that will be the unemployment. Okay, so we can be choosy how we want, but we have to be aware that there will be a backlash, of course, coming from this kind of decision. So either we decide that this kind of, let's say, intervention from the government side is in order to save the economy, and maybe you can do some creative distraction, of course, if you're able to do, of course, and you are able to choose exactly in which direction to go. But let's say discriminating between the viable and non-viable, I think it's a very, in this moment in time, in this season, very difficult.
Thank you, Diva. Now let's go to Carlo Altomonte, who I believe has a question for Douglas. And if you have any more questions, I have a couple coming, but if you have any more questions, just put them in the chat. Carlo.
Thank you, Francine. Thank you, Doug, and all the speakers for the very interesting opportunity. My question is connected to what Stefano and to a certain extent also Diva said before. That is, the report correctly focuses on the risk of capital misallocation, where essentially you can do two types of error: either impose a cliff edge and therefore, let's say, let some viable firms go bankrupt, which is what statisticians would call a type 1 error, or you can have a type 2 error, I mean, letting unviable companies survive. And therefore, there are a number of policy implications, which I mostly agree with, on preventing this capital misallocation to happen. However, the same statistics, at least for Italy, that Marcella and Diva were quoting about the future of Italian companies on the labor force are forecasting 1.5 million, 2 million unemployed people next year, which is almost 10% of the Italian workforce. Now, we do know with evidence from the previous financial crisis that this generation of laid off people has a very hard time in finding the right job again in companies. And there is a research that shows that newly employed people that have entered the workforce after such major crises are, in a way, on a permanently lower wage path because of what we call talent misallocation. They end up in jobs that they shouldn't be getting. So talent misallocation is one of the key drivers of low productivity growth, not only in emerging, but also now in developed countries. Most of economic research is showing this. So my question is, to what extent the same receipts that you are envisaging for corporations can be applied to the labor market? I think these two things should go in parallel, because correctly allocating capital is one thing, but also correctly allocating workers to the new capital and to the new needs of the new firms is also going to be a crucial issue for the recovery and the resilience, if you want, of systems. I just want to hear your opinion on that. Thank you.
Sure. Thank you, Carlo. Okay, several things. Certainly, you're right about type 1 and type 2 errors and the fact that you have to find a balance that you're most comfortable with as a policymaker in terms of that. And touching on both that and Diva's comments earlier, I think it's possible to exaggerate the difficulties of telling viable from non-viable. I think it's important not to make the perfect the enemy of the good. I think if we were to bring you 10 companies with the specifics, you could get at least 8 out of 10 right in terms of which categories they're in. Wouldn't surprise me if you got 9 out of 10 right. And I think as a society, we can use the ability to have at least that level of accuracy to improve the allocation quite considerably. In terms of the talent misallocation, I'm not a labor economist. I won't be able to tell you anything very specific to do with it. I found it hard enough to help write this 88-page report just focused on corporate solvency issues and problems. But the part which does overlap between our report and what you were asking is, and this goes back, I think, as well to Stefano's earlier comment, to the extent that there's permanent scarring of the economy from having people lose their jobs or having companies vanish, and the two tend to be closely related, then that forces you to provide somewhat more general support to balance the type 1 and type 2 errors differently, to take more chance that you might be putting money into a non-viable company. I still think you're better off letting a clearly non-viable company go under and finding other ways of dealing with the talent issues. But it does it does change where you want to be on the policy spectrum as you make these choices.
Thank you, Douglas. Can I just ask everyone to mute yourself unless you're asking a question? And then I have two more questions. The next one is Cosimo Pacciani. Cosimo.
Yeah, yes, I hope, can you hear me?
Yes.
Perfect. Yes, thank you very much for the presentation so far, for the report. I have a question to Douglas because he was referring before about the trends acceleration after the or during and after the pandemic, and I can see on the report you talk a lot about this acceleration. My question is mostly about pretty much because I think at the moment we're also talking about how the governments or the institutions are having some kind of blanket approach to try to protect as much as possible of the current environment, trying to think about a return to normal or a standard that we need to see what is going to be after. So my question is, in terms of these accelerations, because it's more about obviously it's about technology, it's about labor, etc. But do you see any other trends that you think could have an impact? Because I have in my mind some of these potential trends that could even accelerate further. One, for example, what we're seeing at the moment is a potential social unrest and obviously all the challenges of climate change. And it goes back to a second part of the question, obviously acceleration. And then also, I think, reading the report, there is not much about data analysis and how all the data that we're going to have from different sources could be aggregated, utilized, also shared across. This is happening quite a lot now on a risk management world. But so my question is also, what could be also solutions to share more information, what we call today big data, or information across to support scenarios related to the acceleration of some of the trends you were referring before?
Okay, thank you, Cosimo. There are a lot of trends that have either been started or accelerated by this. You're right about that. Everyone talks about digitization, and that's clearly one of the major ones. We haven't talked about, but everyone's well aware, changes in commercial real estate are clearly happening. We don't know how many people will go back to offices eventually and how much time will be spent there. So you'd expect that. Stores, of course, physical stores were in decline already, and that's being accelerated by this. You mentioned some others. Look, I mean, another one is the role of the government in the economy is inevitably going to be substantially bigger for some period of time, and that will show up in multiple different ways, from direct ownership to, I would think, once we get past this period, taxes will eventually be higher than they would have otherwise. There's also a sense in which the public having supported businesses, there will likely be more government mandates on businesses, whether that's about green activity or digitization so that they can meet the future better, or whatever is the flavor of the month. So I would say that's another one. As you say, social unrest certainly could be for some period of time. I think there's probably going to be some larger changes in culture. After World War I in the US, we saw a generation which turned out to be very frivolous, effectively, like the flappers and things like that. After World War II, similar stresses in many ways. We saw a generation that was as conformist as you could imagine and as hardworking as you can imagine. So it's difficult to guess these cultural changes, but I think when we look back, we'll find there were significant ones which will have many ramifications. Look, you're right. There's a lot that can be done with big data and machine learning. I think that's probably too big a topic for me to really tackle here. So I'll just have to let that go.
Thank you, Douglas. There's a question from Stefano Firpo.
No, mine was rather than a question, a comment on what Douglas was correctly saying, that if you don't allow the banking system to work to support the recovery, and you just imagine and figure out it as a simple zero risk industry, then capital reallocation becomes very, very difficult because credit provision tends to be very conservative. Banking official tends to pour money in the traditional sectors and not in the new sectors because they tend to be very prudential. So these two things of a new regulatory approach to the banking system and this issue of creative destruction, in my opinion, goes hand to hand. I don't know if you agree on that.
Yeah, absolutely. Look, again, this is one, the devil's very much in the details, but you do want to find that right balance between safety of the banking system and the proper functioning where it provides the necessary resources to the larger economy.
Douglas, I have a question, and then I know Fabrizio also wants a final question before we wrap it up. But are we so certain that we can decide now what our economies will look like 3-4 years down the line? And we got this question a lot on Bloomberg is, what are the jobs of tomorrow? What should I train for? Like, given the pace of change that we've even went through the last 12 months, how can we be so sure that a company viable now will still be viable in 2 years?
Again, we can't be sure, but I think applying what we've learned to this point and some common sense, you can get 80% of the way there. So no, it's not certainty. And as the pandemic itself shows, we can all be surprised as to what the following years will bring. But I don't think it should bother us that we don't have anything close to perfect knowledge. There's still many choices we can make that will be very positive.
Okay, let's go to Fabrizio for, I think, a question to Douglas, and then the host can finish off the session.
Well, still on this insolvency issue, because sometimes I have a bit of worry that we are looking at this crisis a bit with the lenses of the crisis that we lived through, the great financial crisis, and particularly in Europe, the sovereign debt crisis. My concern is that, aren't we focusing too much on companies and business and traditional businesses like basically manufacturing companies and service companies and so on, and not very much where I think the impact and the effect of the crisis will be, which is shops, mom and dad shops, which are very widespread in countries particularly as Italy, but also in continental Europe, and which have a social function that they place in century, I would say, and that they have also a physical presence in the center, and not only in the centers of cities and towns, but also in villages and so on. I'm not sure there is enough attention in the policy and in the how can I say, let me say in the Group of 30 as a symbol, on this type of issue, which may lead also to social unrest and social uneasiness in the future.
Yeah, look, in terms of the report itself, I don't think you can find any bias one way or the other in terms of sectors of the economy. We've deliberately stayed away from that, indicating that's something you have to look at country by country. In terms of the larger question you raised, stepping away from the G30 report, I think there's a lot of uncertainty as to whether the right approach is to focus on the points you make, which would suggest fairly heavy levels of support for those smaller mom and pop shops, or whether the opposite argument is correct, which many people believe. Well, first of all, in terms of shops themselves, bricks and mortar shops seem to be on their way out. So you'd want to be careful not to just pour money trying to stop the tide from going where the tide is going to go anyway. Then separate from that, there's also a feeling, say the local bar, or many times little restaurants, that they're actually very easy to replace. And that you might in fact find that even the same people who ran those could end up starting another one in a year once we've got past all the social distancing limits. So I have heard arguments on both sides, and I'm not smart enough to know the answer, but there's a genuine debate going on.
Thank you so much. Douglas, I just wanted to thank, of course, our panelists, Diva Moriani, Marcella Panucci, and Stefano Firpo. And then I'll just hand it over to Fabrizio for final thoughts.
Well, my role is just to thank everybody, all the participants, to thank the university, the CESP University, Università Cattolica, who's hosting us as well, and to thank the three discussants, Marcella, Diva, and Stefano, to thank Oliver Wyman, and particularly Douglas Elliott, who, I mean, I think the discussion has been comprehensive, thoughtful, and inspiring, as the report is. I know Federico Arcelli of Oliver Wyman is there as well. Ciao, Federico. He's there waving.
And by the way, I would add, since we're thanking people, Andrew Bailey and Sophia Price, who did much of the actual work, are also on the call. So let me thank them while we're going through the list.
Very good, Andrea and Sophia. Hello, first of all, and thank you. And last but not least, Francie. Once again, thank you for moderating the event. And it's the end. I wish you a good evening and happy holiday season to everybody.
All right.
Thank you. Thank you, everyone.
Thank you all.
Grazie, ciao, ciao.
Bye-bye.
Thank you. Bye-bye.